live on digital radio, colourfulradio.com, and apps. This is Colourful Radio.
As we've been discussing all morning on Business Breakfast with Loanna Morrison and Rob Hayward, Davos is the background to everything. But we're looking at the question of the billions that may be printed in quantitative easing as a result of a decision of the European Central Bank. It's expected to announce later on today that it's entering into a programme of what they call QE, quantitative easing. And although it's specifically for the euro area, the question has been raised as to what implications it will have for the London house price market and for interest rates in the United Kingdom and for business and commerce in the United Kingdom, because as we've been discussing, everything flows from one country to another, from one currency to another. So we will be joined by Resham Kotecha, who is an economist, to discuss these subjects.
Yeah. Good morning, Resham.
Morning. How are you?
Can you hear us?
I can hear you. Can you hear me?
Okay. Yeah. You probably could get a little bit closer to your mic, your phone. Yeah.
Is this better?
Yes, that's a lot better. Thank
Brilliant.
you.
Okay.
Resham, can I just throw the first question, because it has been discussed in Davos, and then there's been the speculation about the decision that's being taken by the European Central Bank. Why does this why does it matter to the United Kingdom that any decision is taken in Frankfurt or across the euro area?
Well, with globalization and with all countries so interconnected, there's no way of stopping money from flowing. So we're expecting it'll be 500 billion euros that's printed in the Eurozone. Obviously, that's going to find its way to other countries. Money will flow to the safest haven, to the safest place. And London, in terms of financial centre for Europe, given most central banks, most big banks have their hubs in London, will see a huge inflow of money. The London housing property is also seen as a really safe haven, somewhere to have an asset that is safe and trustworthy. So we're likely to see a lot of that money that's printed coming straight to London, which will obviously mean greater demand for the pound, so our exchange rate will be affected, greater demand for housing prices. So housing prices in London mainly, but parts of southeast London will rise as well. And it means that we need to be aware of that, because it will then create pressure on our interest prices as well. So it'll also create downward pressure on our interest rates. So there's a lot of effects that will happen in the UK, even though we're not printing money, but all that money printed in the Eurozone will flood out. And we're likely to see a lot of it, given that we do 45% of our trade with the Eurozone. So our exports and imports will be affected. There's a huge impact that will happen that we can go into.
Can I pick up a number of different points that you've raised there? First of all, you said 500 billion. Is that, in real terms, a large sum of money? Is it a medium-sized amount of money? What is the judgment of the stock exchanges around the world as to the size of this sum of money?
It is a large size of money. It's less than the UK and the US have done when they did their programs of quantitative easing relative to the size of the economies for the countries involved. But the UK and the US did their programs over a prolonged period of time, whereas the Eurozone, the speculation is when they announce today, it will be a sum of money in one go. So in that sense, as a one-off quantitative easing program, it is a large sum of money. We just need to wait and see, firstly, if it's the amount that we're expecting, and secondly, how effective it is. Will take a few weeks to even months to see the impact. So it's a little hard to say whether it's big enough, but so far the financial markets seem to be acting as though it will have a positive impact and pull out the Eurozone from its deflationary downward cycle that it's entering.
So give us a little bit more detail about what they're hoping to achieve by flooding the European Union, the European economies with this money. What are they hoping to achieve?
Sure. Well, the idea is that the European Central Bank would create money. They would then buy government bonds, which puts more money into the system. So they're essentially creating money from nothing. That in turn will mean people have more money. banks are more likely to lend out to consumers. So people will go out, people like you and me could go out and find it more easy to get money from the banks. Firms will find it easier to borrow, and that should fuel spending. So people should buy more goods and services. And the hope for that is that as demand for goods and services goes up, it boosts inflation. Right now, the inflation rate in the Eurozone is minus 0.2%, and the risk of entering a downward spiral is that firms earn less, government revenue earns less, but debt does not decrease. So it's a very difficult situation to be in, and the aim is that by creating extra money, people will then spend enough that we avoid a Eurozone deflationary period. So the aim is to get people to spend more. The problem is when everyone expects something like this to happen, people are already taking into account the feeling that they will have more money. So it might not be as effective as the Eurozone are hoping. And so we need to wait and see how the financial markets react today as to whether investors and people think it's big enough and the effect will be enough. And if it is enough, what we'll see is a lot more spending over the next few weeks and months.
Can I pick up on another thing that you mentioned in your opening comments, and that was that a lot of it is going to come to London because London is the financial centre for the whole of Europe and one of the biggest for the whole world. What's the benefit for the euro area if all this money is going to come to us? Yeah, surely this is precisely what the euro area doesn't want.
It's a very good question. Initially, we will see large floods of money coming to the UK. Now, the effect that has, demand for the pound will go up, which means the pound becomes more expensive, and demand for the euro is falling relatively, so the euro becomes cheaper. Now, initially, it seems like we benefit by getting all their money, but actually they benefit because the euro now becomes cheaper, which means that if you're selling goods from the Eurozone, they are now relatively cheaper than British goods, which means that you will export more goods to the UK, and the UK will start buying more European goods, which will increase demand for European goods. So in that sense, we lose out because the pound and therefore British goods become more expensive, and the Eurozone will benefit because their goods become relatively cheaper.
But one benefit under those circumstances is that obviously that people going on holiday will find their holidays in Spain or Italy or wherever that bit cheaper. But can I just ask on that, is this going to distort the economies markedly, or is the implication of what you seem to be saying is that over a period it will be a boost but it will settle down and the whole of the euro area and the UK and others will benefit from not only house prices but manufacturing growth, for example?
Well, the UK will actually be harmed in terms of our manufacturing sector because British manufacturing will become more expensive. So we're expecting in the short term, in the UK at least, for manufacturing to be hit slightly harder. Although, as you mentioned, holidays become cheaper. There are always, with economic programs, pros and cons. Some people benefit, some people lose out. If you base yourself in the British tourism industry, British holidays now become more expensive than European holidays. So everyone wins, everyone loses in different ways. You know, if you buy European goods, they're now cheaper for you to buy in the UK. If you make UK goods to sell abroad, they're now less in demand. But overall, we don't think the 500 billion will have such a big effect, if it is 500 billion, that we're affected too much in the long run.
Well, I just have one small quick question before we go, because we're running out of time.
Of course, sure.
I just wanted to say, you know, the way that we had quantitative easing and the banks didn't do what they were supposed to do. So they didn't lend money, and they're still not lending money. And if that happens in the Eurozone as well, what's the outcome?
Well, for us, 2009 was the first time the UK had tried a proper program of quantitative easing. And as I mentioned, it's partly about how investors and people form their expectations. So people are expecting quantitative easing. If they don't feel the program is enough, they won't be brave and lend out money because they don't think it's worth it. So if banks don't pass on money, the same way the UK problem was, if the Eurozone banks don't lend out more money, then essentially they'll have created money and there will be no impact. So what really needs to happen is there needs to be an incentive for banks to lend out money.
Right.
If you save money, in this European Central Bank, if you're a big bank and you save money, you're actually paying a negative interest rate. So you are paying to keep hold of the money. So actually there is an incentive for banks to lend out money. At least they can earn some money, whereas this way they're paying to save.
I'm unfortunately going to stop you right there, but that was fascinating, and hopefully we'll have you on again because I'm sure this is a story that's going to run and run. Right now we'll go to a quick break,
sure it is.
And we'll come back with our next guest. Thank you so much. That's Resham.
This is Colourful Radio.
Our music, our news, our
views.